In 1970, the average US worker took home 53% of the total value they produced. Today, that number is just 34%. Imagine slicing 1/3 off your paycheck, year after year, while someone else quietly collects what you've lost. If you feel like you're working harder than ever, yet ending up with less, you're not imagining things. Those missing dollars add up to hundreds of thousands over a lifetime. Dollars that haven't vanished. They've just been redirected. So where did your share actually go? And why is the system built to keep you from seeing who's behind it? Stick with me, because in the next few minutes, I'll pull back the curtain on decades of money flow and show you the 8 practical steps that put more of your work back in your pocket. All numbers in this video are sourced and cited, so you can see the real story for yourself. Let's start with a simple reality check. Your effort is producing record value, but your pay is capturing less and less of what you've earned. This isn't a fluke. It's a pattern engineered over decades, and right now, it's compounding against you. Let's break this down chapter by chapter so you see exactly how the system moved your share upward away from your wallet and left you working harder for less. Chapter 1. The Golden Era, when effort was rewarded. Back in the post-war era, the American economy ran on a deal. Companies needed workers more than workers needed companies. One steady income could buy a home, raise a family, and build real savings. If you produced value, it flowed right into your pocket. The reason was simple. The system relied on you. Wages and productivity rose in tandem. If you showed up and put in the hours, you moved up. But the rules started to change in the 1970s. Chapter 2. The 1970s. Shift. The start of the divide. By the mid-70s, companies realized they could increase profits more by controlling labor costs than by growing sales. Production started moving overseas, automation wiped out entire jobs, CEO incentives shifted. Instead of rewarding shared prosperity, corporate boards rewarded cost-cutting. The critical point? Productivity kept climbing, but wages didn't. According to the Bureau of Labor Statistics, American workers' productivity soared 77% from the 1940s to the start of the 1980s. Yet median hourly compensation grew under 13%. The economic pie got bigger. You just got a smaller slice. Let's make it real with a story. Diane was a 43-year-old assembly line worker in Ohio during the 80s. She earned $9 an hour, which had once comfortably covered her family's bills. As factories started outsourcing and installing more machines, her hours shrank and healthcare premiums more than doubled. Her monthly rent rose 35% from 1982 to 1988, and groceries kept creeping higher. By the end of the decade, her real income had fallen by nearly 15%. She took on weekends cleaning offices just to keep up, regularly logging 60-hour weeks. And despite all that hustle, her savings vanished, her kids had to skip college, and she was left exhausted and exposed. The numbers here are composite estimates to illustrate the pattern, but if you're anywhere near Diane's situation, let me know. Do you feel your pay matches your effort today? Drop yes or no in the comments right now. Notice, Diane's experience wasn't isolated. These shifts rewired the entire economy. Chapter 3. The 1980s. Financialization Unleashed. The 1980s marked a whole new playbook. Financial markets were unleashed, and suddenly, maximizing shareholder value became the golden rule. What did that actually look like for regular workers? Executive pay started soaring out of distance from average wages. Stock buybacks replaced raises. Deregulation allowed mega mergers, enabling a few companies to dominate entire industries. From 1980 to 1998, corporate mergers quadrupled, according to the National Bureau of Economic Research, slashing competition and further tilting the scale. Your effort, your missing dollars, didn't vanish. They turned into someone else's profits. Let's put numbers to it. While productivity soared 77% from the 1940s to 1980, median hourly compensation for workers grew less than 13% in the same period. Economic Policy Institute. The rest became corporate profit or executive reward. Every gap in that percentage is value extracted from you and redirected. Chapter 4. The 1990s. Efficiency, but for whom? The 1990s didn't slow things down. Technology and globalization created even more efficiency, but the gains went up the corporate ladder, not into workers' pockets. Manufacturing evaporated, and new jobs demanded more skills for less pay. Corporate lobbying surged, shaping tax codes and labor laws to suit owners, not workers. Let's zoom in on how this hit families. Marcus, a 32-year-old office assistant in Chicago, landed a job in 1993 for $31,000 a year. He could just cover rent at $700 a month, groceries, utilities, and a car payment. Then costs started climbing. By 1998, his rent was $950, and annual raises barely kept up with the 2 to 3% inflation Department of Labor. Student loans hit with $200 payments. Overtime meant more work, no extra pay, and he was upskilling himself just to compete. By decade's end, he made $35,000, but price hikes ate every gain, and healthcare premiums rose 40% in 5 years. His savings stalled, and his dream of buying a home drifted further away, while the system said everything was working. Again, the numbers here are composite estimates for illustration. If this feels familiar, or if your biggest cost has jumped lately, rent, health, food, type which ones hit you hardest below. Here's the headline from the US Census. Home ownership for people under 35 dropped from 43% in 1990 to 38% by 2000. Incomes couldn't keep up, and a new generation got shut out of the American dream. Chapter 5. The 2000s. The era of debt and buybacks. If you think things couldn't speed up more, the 2000s raised the stakes again. Financialization took off. Corporations could borrow cheaply, use those loans to buy back their own stock, and prop up share prices without raising worker wages. It was a golden age for profits, not paychecks. Just look at the numbers. According to the Economic Policy Institute, stock buybacks among S&P 500 companies leapt from $119 billion in 2003 to over $800 billion by 2018. That's not just a few billion. It's a total transformation of where profits go. Meanwhile, real life got more expensive. The average in-state tuition at public four-year colleges more than doubled between 2000 and 2020, College Board. Healthcare costs entered the stratosphere. Housing spiked. Wages? Still slow and steady as expenses took off. The pain wasn't abstract. It was visible in every bill, every loan, every missed opportunity. And as the gap widened, the winners weren't invisible. They just hid behind market complexity and legal structures. Mid-video freebie, if you want the actual sources, detailed charts, or a personalized checklist to reclaim more value in your life, check out the description. I put all these resources there for you to use. Chapter 6, 2008 to now. Shock, recovery, and the new normal. Then came 2008. The system crashed, and regular people paid the price. Foreclosures, job losses, evaporated savings. But the bounce back wasn't for everyone. According to the Federal Reserve, the household net worth for the top 10% snapped back to pre-crisis levels by 2011. Median net worth for working families? Still down nearly 40% from 2007 to 2013. The stock market recovered long before families did. If you ever felt like you worked your way out of a recession only to find you'd fallen further behind, now you see why. Each shock, the dot-com bust, the Great Recession, every financial crisis reset the system stronger for the affluent and institutions, but weaker for regular workers. It's not a glitch, it's design. Chapter 7, the 2020s. Work more, get less. Today, it's fast-forwarded to daily reality. Prices shoot up, housing becomes unreachable, debt surges sky high, savings rates drop. Even as technology supercharges our productivity, the rewards don't filter down. Instead, 2023 saw corporate products break records. But for the average person, more hours, less security, and your share, smaller than ever before. Let's look at Sophia, a 28-year-old who juggles gig jobs, drives rideshare at $17 an hour, and works at a cafe for $15. On paper, that's $2,700 a month, but rent, insurance, and student loans eat almost everything. Groceries spiked 11% in 2022, and median U.S. rent jumped 17% from 2020 to 2022, USDA and Reuters. Most months, Sophia logs more than 60 hours of work and still can't save. To cover big costs, she turns to Buy Now, Pay Later (APPS). But it's a treadmill. Meanwhile, Uber, the app she drives for, posts $1.9 billion profit in 2023, up 50% in just 2 years, Uber annual reports. Nearly 60% of gig workers say they struggle to cover basic monthly expenses. Pew. And since 1979, income for the bottom 90% increased only 28%, while the top 1% saw 343% growth. Economic Policy Institute. Illustrative numbers, but the direction is clear. And if you're in a similar ride, let's share what's helped or hurt in your situation below this video. The share of value you take home today isn't just lower, it's dropping every year. That's true for nearly everyone. Chapter 8. Understanding the Extraction Engine. So what's actually happening under the hood? Why does every extra hour, every raise seem to slip away faster than ever? When your wages rise slow but prices shoot up, your paycheck loses buying power, housing soaks up more, healthcare eats a bigger chunk, student and auto loans tack on extra costs, corporations take gains from cutting expenses, not raising wages, productivity spikes but profits go to shareholders, not workers. Debt quietly siphons away your future. Inflation gnaws at savings, outpacing wage growth. Every part of the system, from tax laws to healthcare to college costs, has been restructured to reward asset owners and shareholders, not earners. According to the Tax Policy Center, recent federal tax cuts saw the top 1% claim 20% of the benefit, while the bottom 60% received less than 15%. Housing became a speculation market. The median home price nearly doubled from 2012 to 2022. National Association of Realtors. In just the meatpacking sector, 4 firms now control 80% of the market, leading to 30% price hikes over the decade, FTC. Healthcare spending per person soared 53% from 2010 to 2022, Peterson KFF, with minimal movement in life expectancy. College is now a toll gate, not an accelerator, with $1.7 trillion in national student debt, Federal Reserve. Even when companies post record profit, workers' pay lags behind inflation by over 4% in 2021 to 2022. Bloomberg. 70-year high corporate profit margins, yet most people fall further behind. If you're wondering what's your biggest leak, debt, taxes, healthcare, or housing, think about which cut has hurt you most over the last 5 years. Type it in the chat. Let's build a real MAP of our community's pain points. Chapter 9. The pie shrinks and why that matters. Here's a visual for you. In 1970, workers kept 53% of the value they produced. In 2023, it's down to 34%, Economic Policy Institute. That's not just a dip. It's the difference between building generational wealth and fighting to stay afloat. Picture a pie chart. Every decade, your slice gets thinner. That's money that isn't missing, it's just being routed somewhere else. What you're missing in each paycheck is building someone else's fortune. Let's change that. Chapter 10. The system was designed, and you can design back. Now, here's the hard truth. This widening gap isn't an accident or a malfunction. It's an intentional feature built into the system by decades of policies, incentives, and industry consolidation. You can't outwork extraction. You have to out-strategize it. The good news? There are steps you can take starting now to reclaim more of your effort. Before we get tactical, remember, all case studies here use composite numbers for illustration, and this is educational content, not financial advice for your particular circumstances. For exact recommendations, consult a licensed financial advisor. Let's break down the 8 strategies that redirect value back to your life. 1. Build skill stacks. Don't settle for a single skill or job. Stack high-demand abilities, whether it's tech, communication, management, sales, or data. High-demand skills jump you to roles where pay rises faster than average. 2. Prioritize assets, not lifestyle creep. When you get a raise, invest in assets, stocks, index funds, real estate, a business, not just expenses. Assets rise in value over time. Lifestyle spending disappears. Remember, investing comes with risk. Past performance doesn't guarantee future returns. Consult a pro before making decisions. 3. Minimize leaks. Identify high-interest debt, unnecessary subscriptions, inflated service contracts. Every extra dollar you keep is one not extracted by lenders or corporations. Use a free debt tracker or budgeting app to plug these holes. You'll find links in the description. 4. Negotiate aggressively. Negotiate your salary, your rent, your bills, every contract. Silence is expensive. A single negotiation can unlock thousands over a year. Download my negotiation script title below to get started. 5. Diversify income streams. One paycheck is not security, it's exposure. Add freelancing, part-time, online, or gig work, whichever fits your skills in life. Check the resources for a calculator to see how much side income could change your margin. 6. Reduce system dependency. Rely less on channels designed to extract value from you. Start a side project, build up savings, own your investments, or even consider starting a small business. The less you depend, the more you retain. 7. Protect your time. Time is the one resource every system hopes you won't track. Audit where it goes, cut what's extractive, invest in what's compounding. Use my time audit worksheet, link in the description. 8. Understand the machine. Learn how the system moves value so you can spot both the leaks and the opportunities. Bookmark this channel, download the 8-step checklist, and use the wage/wealth loss calculator linked below. And again, no single strategy can guarantee results, and systems shift with every market change. But stacking actions, using the right tools, and keeping awareness high puts you on the side of compounding value, not loss. If you want follow-up resources, the printable checklist, my negotiation scripts, and the wage loss calculator, check the links or description below. And if you've got a friend who needs this breakdown, share this video with them or download the summary and forward it on. Let's build a smarter future together, one step and one strategy at a time. Let's recap everything we've broken down. Over the last 5 decades, your share of the value you produce has gone from 53% to 34%. Not because you worked less, but because the system shifted behind the scenes. Corporate profits, asset prices, and debt all grew, while take-home pay and net worth for most families lagged or dropped. But that's not destiny. It's design. And with these 8 strategies, you can claim back more of what's yours step by step. So here's what to do next. Today, download the checklist from the description and use the wage wealth loss calculator to get your personal number. This week, identify one big leak, whether it's debt, subscriptions, or contracts, and take one action to plug it. Over the next 30 to 90 days, commit to rebuilding one skill in demand and consider adding a side income stream. And for the long run, track your progress, review your tools every quarter, and update your plan as conditions change. Use the negotiation script and time audit worksheet as you go. Every step compounds. Results won't appear overnight, but in 6 months, you'll have a measurable reduction in leaks and more margin. In a year, you could see net worth move upward. Remember, every % you redirect now is worth many times more over a lifetime. It's not about perfection, but consistent progress. For more deep dives and proven strategies, subscribe to Homer Invests and turn on notifications. Next video, I'll walk you through how to use that wage loss calculator in detail and show historical returns with full risk analysis so you can make data-driven decisions for your future. And don't forget, drop your single biggest money question in the comments below. I'm answering the top ones in the next video, and our full resource pack is linked right here, free for the community. And most important, this content is educational, not financial advice. Past performance doesn't guarantee future results. Please consult a licensed financial advisor for personalized recommendations. Your future deserves it.